The US dollar's been strengthening rapidly since June of last year, and some people say we've entered a dollar doom loop, which could create deeper economic problems. So in this video, we look at why the dollar's been strengthening, why it matters, but also what we mean by a dollar doom loop. And then finally, what could snap us out of the loop and finally weaken the dollar. Now, don't forget, it helps me a lot if you subscribe to my channel, so please do subscribe if you enjoy this video. So let's look at the dollar doom loop in a bit more detail. Let's begin by looking at what's been happening to the dollar recently. Now, one thing is to compare the dollar against single currencies, but what I've done here is look at a basket of currencies, and this is the trade-weighted dollar. And if you want to see the weights of that basket, you can see it in this table. By far the biggest weighting is against the euro, because that's where most of the volume is in the currency markets. Now notice that since the trade-weighted dollar reached a low in June of 2021, it's been accelerating upwards very rapidly. And that's because the dollar's been strengthening against this basket of currencies. If we do break it down to single currencies and we look at the returns since that low point in June of last year, the size of the moves have been absolutely huge for major currencies. So the dollar's gained about 25% relative to the Japanese yen, 23% versus the Swedish krona, and about 20% versus the euro. And for UK investors, the 17% appreciation of the dollar has actually helped us because it reduced our losses for US equity. Why has the dollar been strengthening? Certainly over the short term, what happens is if people are scared, in other words, equity markets are selling off and risk appetite is generally falling, then usually that makes the dollar appreciate. That's because it's seen as a safe haven currency, probably the safest in the world. And certainly 2020 was no exception. When we had the big pandemic sell-off, there was a huge spike of VIX above 80%. And if you look at the trade-weighted dollar, sure enough, it rallied very rapidly during that sell-off. Another period when that happened was in the global financial crisis. Again, VIX went above 80%, and again you can see that the dollar rallied as a result. Another reason that the dollar might rally is because of interest rates. Generally, if an interest rate is higher in one country than another, then that makes its currency appreciate relative to that other currency with a lower interest rate. So if we look at the very rapid appreciation of the dollar in 2014, that was because many people expected the US to raise interest rates before everyone else. And that was because its economic recovery was faster than other developed markets. So these are the two primary drivers: fear, which works over the short term, and interest rates, which usually work over the longer term. So here what I've shown is the policy rates of many central banks, including the US. So that's currently 1.62%. But notice how all of the central banks cut interest rates to zero following the pandemic in order to stimulate growth and to lessen the effects of the pandemic. And now that we've had this spike in inflation, all central banks have been raising interest rates very rapidly, with the exception of the euro area, which has also now started to hike, and the Japanese central bank, which is also still very accommodative. So because the US has been growing more strongly coming out of the pandemic, it's been able to raise interest rates more aggressively with less fear of crashing its economy than, say, the UK or Europe. And in turn, that's meant that interest rates in the US have been higher than elsewhere, and that's strengthened the dollar. So this is just the short end of the interest rate curve. That's what monetary policy determines. But if we look at the long end of the interest rate curve, so here we're looking at 30-year US Treasuries, but also 30-year UK gilts, 30-year German bunds, and 30-year Japanese government bonds. Notice how the US yields are the highest of all of them. So US yields, as I make this video, are over 3% versus 2.5 for the UK, 1.3 for Germany, and just 1.2 for Japan. So at the long end of the curve as well, you can see that greater growth is priced into the US curve. And in turn, that attracts capital to the United States and strengthens its currency. Currencies fluctuate all the time, so why does dollar strength matter? Certainly for some companies which import lots of goods and services, a strong dollar can be a good thing because it makes those services and goods seem cheaper. However, for exporting companies, things work in reverse. And the example shown here in the FT is Netflix, which does export a lot of services abroad. And as the FT says, that's wiped billions off US corporate earnings for these exporting companies. And if we look at the shareholder letter for Q2 from Netflix, you can see that foreign currency has had a huge negative impact on their revenue. If we look at the year-on-year growth, it's dropped that revenue by $339 million. And that impact is 4% of their total revenue. And they go on to outline the reasons for that impact. Primarily, it's because 60% of the company's revenue comes from outside the US. Now, if the costs of the company were also denominated outside the US, that wouldn't be such a problem because those costs would also go down alongside the revenue. However, in the case of Netflix, that's not the case. Most of their expenses are actually in US dollars. So it's the worst of both worlds. And that's why swings in FX, that's the currency, the dollar strength, have had a large flow through to their operating profit. And in fact, they say in future they're going to strip out the effects of currency and show their results based on currency at the beginning of the year. If they do that for 2020, you can see it also had a big negative effect, as it did in 2021. If we look at sectors in the United States, they vary widely on how much of their revenue is generated outside the US, which is shown in light blue here at the top of the graph, and how much revenue is generated within the United States, which you can see in dark blue. So the sectors which are mostly domestic in terms of revenue generation are utilities, real estate, financials, industrials. And the companies which generate a lot of revenue outside the United States are information technology, that's companies like Netflix, but also materials companies, consumer staples companies, communication services, and energy. So really the impact that we expect to see from a strong dollar varies widely based on a company's sector. But if we look at the S&P 500 as a whole, most of its revenue is generated within the United States, 60% of it in fact. A strong dollar can also cause problems outside the United States. It often triggers emerging market crises as emerging market currencies devalue and also their debt servicing costs in dollars become more expensive. And another problem is called pass-through inflation. So here the Bank of England member, Catherine Mann, says that the UK must raise interest rates aggressively. And the justification she gives is that if we don't do that, then we'll have a very weak currency. And that means that any goods and services which we import, and we are a net importer of goods and services, will be more expensive. So to avoid that pass-through inflation from a weak currency, the UK can raise interest rates and that way strengthen its currency. If you are interested in macroeconomics, in topics such as the dollar doom loop, for example, then why not sign up for our free weekly market roundup? I publish it every Friday. I try to keep it short and punchy, and of course it's absolutely free. If you want to learn more about that, just click on the link beside me and in the description beneath me. Now let's look at the dollar doom loop. Now the way this cycle works is that initially we get a stronger dollar, as we've seen recently, and that leads to lower global manufacturing, and that's for reasons that we're going to see in a moment. Lower global manufacturing leads to lower commodity prices, which at the moment wouldn't be such a bad thing. Then we get lower global trade, and then worries about global growth then lead to the stronger dollar. Because as we've seen, fear in markets, particularly about growth, tends to make the dollar go stronger. So this becomes a self-reinforcing cycle, but it's a harmful one because it reduces global trade. Now, what's the evidence that a strong dollar reduces the amount of manufacturing? Well, one thing we can look at is a purchasing managers index. That's a leading indicator of what happens to GDP. And the third graph you can see on the right here on this panel is the purchasing managers index versus the dollar index, which is what we saw at the beginning. Now, when the dollar index strengthens, that's what you can see on the right of this graph. Notice how the PMI indices drop. So that shows a negative effect on manufacturing. To see why that's the case, let's imagine that we've got a global supply chain firm, which is based outside the United States. So this might be an electronics manufacturing company which assembles components and then ships those finished goods to the United States. Now, such a company has large capital requirements. It needs a lot of money to buy certain things. So, for example, it might need to fund things such as intermediate goods. If it's assembling electronics, it has to buy those electronics to assemble them. So that's an input cost for the company, which has to be funded. Then even if it sells goods to a company further down the supply chain, it may be delayed receiving payment for those goods. So it'll also need to finance those accounts receivable. Now, if these financing requirements can't be met by the resources of the company, then it would have to borrow. And usually that means bank credit. A lot of financing is done from banks. Now, a lot of that financing is itself done in dollars, even if the company is not based in the US. Now, if it's having to service dollar debt, that company will be very sensitive to the strength of the dollar. So the cost of financing the debt actually goes up if the dollar's strong. So this is the way in which credit conditions can tighten effectively for companies all over the world if the dollar strengthens. That means that the funding costs get more expensive. Now, in this crisis, what we've seen is slightly different, and a lot of it's been driven by very high commodity prices, particularly for energy following the pandemic. So here we'd be thinking about companies in, say, Germany, where gas prices have surged, or Japan, for example. Those countries have to buy gas, which is denominated in dollars, so if their currency weakens, that pushes up the price of those commodities in domestic currency. So that's the first problem. But then if manufacturing becomes prohibitively expensive, and we've seen Russia threaten to turn off gas supplies to Germany, for example, then it might actually reduce the amount of manufacturing. So on the one hand, the country is having to pay more to import energy, so the cost of its imports have gone up, and at the same time, it's manufacturing less, so it's exporting less. So its trade balance, which is the difference between the two, is going into negative territory. So what we'd expect to see is a trade deficit. And we've already seen that for Germany for the first time in many years. Now, so far, it's not because exports have been falling, but if the gas supplies really do get cut off to Germany, I'd expect that would happen too. So far, it's been because of more expensive energy imports. Now, if the manufacturing base in Europe collapses, what we'd expect is weaker growth, which is terrible for Europe, and in turn, that would lead to a weaker currency. So this is how the loop could be worse this time around, particularly for Europe and for Japan. So finally, what will break the loop? Well, instead of raising interest rates, we might see the Fed start to slow down its rate hikes or even go into reverse. However, with inflation in the US above 9% at the moment, I think that's unlikely, at least for a while. Commodity prices have started coming down, but it'll take a while for things like housing and shelter to come down. That's a sticky inflation component. So I'd cross this one off my list as closing the doom loop for this year. Another possibility would be that growth outside the US surprises on the upside. If that were the case, then we might expect to see those countries, their currencies would appreciate relative to the dollar. We'd also expect to see yields go up at the long end of the curve for those countries. However, again, I think that's unlikely. Of all developed markets, I think the US is pretty well suited to weathering this storm, particularly because it's largely self-sufficient for energy. So I'd also cross that one off my list of likely suspects for breaking the loop. What I think's more likely is that commodity prices will fall, maybe not take away inflation, but it'll certainly reduce it from its currently very high levels. The reason why that matters is that it'll make central banks less likely to hike, or at least be less aggressive in their rate hikes. And one of the reasons why the dollar's been so strong is that the Fed could be more aggressive in its rate hikes because of the strong US economy. So if commodity prices fall, then this competition amongst central banks to hike will actually dissipate. Another possibility which has ended the dollar doom loop in the past is that China stimulates its economy. We've seen big problems with the housing market in China this year, so it may try to overcome that, as well as the negative effects of its zero COVID policy by having a large stimulus. That would be positive for risk assets in China and beyond, and also good for global trade. And also, I suspect, that could be the end of this dollar doom loop. And then finally, and more positively perhaps, we could get an equity rally. So it might be that risk appetite returns to markets and we see that the dollar weakens just as it's been strengthening as equity markets sold off. So you can see why for some large US companies, a lot of them big tech companies which dominate those US indices, the very strong dollar has been a problem. And that in turn could be a problem for the US equity markets unless the dollar starts to weaken for the reasons we've seen. So let's hope it's for something good like an equity market rally. But I think a China stimulus or potentially falling commodity prices could also do the job. Now, don't forget our offer. If you do want to learn more about macro, you can do that by signing up for our free weekly market roundup. And there'll be more about that in the link beside me and in the description beneath me. And of course, you can always subscribe to our channel. That way you won't miss any of our new videos. So as always, thank you for listening.